I want to start with Stellantis. So, this is the car maker that makes Jeep,
It's
Dodge,
Chrysler.
Ram. Yes. Chrysler, yeah, Fiat Chrysler, exactly. Down 23%. So get this, it is taking a $26 billion charge. This is mainly linked to reversing course on its electric vehicle strategy. This is much more than what Ford, GM, Porsche announced. So it's going to cover the cost of canceling EVs and compensating suppliers.
Alexis, Brockton, Patriots or Seahawks? Patriots. Okay.
There you go.
Continue.
It's done. So Stellantis, we know, got a new CEO last year, and he is blaming his predecessor for all of this. He's saying he went all in on EVs. It wasn't a good idea. Yeah, hindsight's 2020. So the stock it's been going through it, down 26% in the past year. And when you look, I took a look at its rivals, Ford and GM, quite a different story. Ford up 48% in the past year. And GM, I didn't realize this, up 74%.
And the reason they're up is because they have pulled back from the EV commitment sooner.
That's right.
And that's what the market wants to see. They don't want to see these companies throwing all this money into an unproven technology. Take it slow approach is kind of what I'm hearing.
But EV's growing. I'm getting in more EV cars. That's what I know.
And there are more charging stations, which I guess will help.
In Paris, I must admit, it was really cool,
Totally
like
different.
on a lot of streets, to see a lot of charging stations.
Yeah.
Yeah.
It's totally
Europe's
different
ahead of
the rest
us
the
on
world.
that.
Yeah. The
Way
rest of
ahead.
the world is.
Yeah, even though they have older infrastructure. Okay,
Yes.
let's move
Next.
on. Molina Healthcare shares plunging 31%. So the health insurer forecasting annual profit that was less than expected, and its adjusted earnings of at least $5 a share, well below what was expected, which was nearly $14 a share. The story here is Molina is going to stop offering Medicare Advantage prescription drug plans for 2027. And Molina's mostly selling Medicaid plans. So that's the way it generates most of its revenue. Look, a lot of these insurers are struggling right now, right? Because high medical costs are making it hard for them to price plans at affordable levels and still generate the profits that investors have come to expect. So Molina's getting punished today. Stock down 38% in the past year because it struggled with forecasting lower revenue last year. So it's been in a funk. It just can't seem to get out of it.
I was just reading the Bloomberg Intelligence Instant React. It's all about management credibility. Management just lost all their credibility. It's going to take a while to get that back.
Yeah,
That
right.
is
That's
bad.
a slow build there.
That is bad.
All right, and then let's talk about a company we all know, we might not all be wearing it, and that's part of the problem, Under Armour. The stock is up, though, 3% right now. The CEO trying to spin it here, saying the turnaround slowly taking shape, and it certainly cannot come fast enough for investors because Under Armour stock down 17% over the past year. It says despite continuing headwinds, including those pesky tariffs, it has managed to exceed analyst expectations in the third quarter and raise its profit guidance for the fiscal year. But you know what? North American demand for Under Armour products down 10%. That's a major market. And so it continues to lose market share to companies like Nike. Maybe there's an opportunity there with Lululemon because we know Lululemon's been losing ground.
Are they in competition with Lululemon?
Yeah, in some ways, some of the athletic wear, I would say they are.
Athleisure.
Athleisure, right?
Yeah.
Do
I'm
excuse.
very athleisure.
Athleisure today. So that's how it's
It's stock movers.
It is.